Hey, everybody, and greetings from the Nook on the 10th floor. Thanks for the time today. Hopefully, we'll keep this pretty brief. So, this is designed as a supplement to Alan Good's Moat training. We'll upload the video for that later, and you have access to the slides right now if you want them. The goal of this training is to provide just a little bit of context and a couple helpful tips and tricks as you prepare for your Moat pitch training. And I'll hopefully provide a little bit of context about why moats matter, things to look for, and things to avoid as you craft your pitch and get ready for your presentation. So, with that, many of you will be familiar with this already, but economic moats are Morningstar's core IP, one of the most important things we do, and that's why we treat it so seriously. It flows into a lot of really important products, most notably our VanEck Moat Index with more than $10 billion in AUM. Uh, Basically, the way that we consider economic moats is we look at them as structural factors that allow companies to derive excess returns for an extended period of time. So you've probably heard this a zillion times, but it's not the excess spread, the spread between return on invested capital and weighted average cost of capital that matters. It's the projected duration that informs whether a company has no moat, a narrow moat, or a wide moat. Probably one of the better illustrations of this is you can look at companies that have very little asset intensity, like a software firm, for instance, or a consultancy, and their return on invested capital will be quite a bit higher than their cost of capital. But the duration of that moat is quite a bit less guaranteed than you might see with 20 years of patent protection, for instance, on a new drug that's projected to be a blockbuster in the pharmaceutical industry. Um, a good way to think about it would be that narrow economic moats are more likely than not, a company is more likely than not to generate excess returns for a decade or more. For a wide economic moat, a company should be almost certain to generate excess returns the next decade and more likely than not to generate excess returns between years 10 and 20. In the long run, we project in our model forecasts that returns converge to cost of capital over time, about 9% for a diversified equity index. Basically, the idea is that capitalism and Schumpeterian destruction guarantee that if companies can raise capital at a certain rate and invest it and receive a rate higher than that, then they will do so until those economic profits are competed away. Economic moats are great because they're structural advantages that prevent competitors from doing that. So, for instance, even if I wanted to build out a really lucrative phone product and an ecosystem of earbuds and watches and blue text messages that carved out a really wide moat around my company, it would be challenging to do so given the brand that Apple has built over the past couple of decades. And so it would take quite a while for that moat to erode and for the cost premium that Apple is able to charge for that suite of products and the network effect that it's built around it to erode. So that's basically what we're looking for. We have five sources of moat: intangible assets, cost advantages, network effects, efficient scale, and switching costs that you've all probably seen in your own coverage in some capacity and that you can see further in Alan Good's slide deck if you want to look at individual moat sources. The important thing for the confines of this presentation is that moats have a pretty meaningful impact on valuation and excess free cash flow. If I can borrow money at a 9% rate and I can derive a 30% return on investment, you can imagine that creates a lot of economic value for shareholders. And that's basically what we see as we plug it into our model. So we value firms on a free cash flow to the firm basis, and we discount that at their weighted average cost of capital. And then from that, we subtract the market value of debt to get to our fair value of equity. For Modi companies, we're basically looking at the middle slice, so not the cash flows that we forecast in our 5 or 10-year horizon, and not the terminal value, which is the perpetual value of a company as a going concern when they're earning cost of capital returns, but that slice in the middle where they may still be earning excess returns on invested capital, even as competitors are trying to encroach upon their turf. And for Modi companies, this slice can be really valuable. So if I have a 10-year model for Chipotle, as you can see in the bottom right, but a wide moat name, that stage two, that years 10 to 20 period, generates $14.4 billion of my estimated valuation. So a little bit less than a third of my total valuation could be attributed to the moat rating that we assign for that firm. If we believe that a firm has a moat, it basically means we expect it to continue to generate excess returns on capital beyond our explicit forecast horizon. And our degree of confidence depends widely on the business, the industry that it sits in, and the structural competitive advantages or moats that we think it has. Notably, for all companies in the long run, we do think that returns will converge to cost of capital. Our model basically projects that out in about 20 years, and the value from stage three is considered as a perpetuity. It's just what's left when the business earns cost of capital ad infinitum. In terms of moat rating distribution, we tend to cover moatier firms, which makes sense. We cover the biggest, highest quality firms in the index that account for the largest portion of market cap and obviously client interest. So you can see that within our analyst covered universe of 1,500 to 1,600 stocks, only 41% don't have a moat, 44% are narrow moat, 15% are wide moat. That's a pretty sharp contrast with the quantitative research coverage, which would suggest that 77% of companies do not have an economic moat. So in general, we cover higher companies. It's not unusual if your list has more Modi firms than not Modi firms, uh, obviously dependent on the industry that you sit in. A decent place to start as you think about whether your companies might have moats is looking at the distribution of moats across our industry and sector coverage. You can see that consumer cyclical and consumer defensive stocks are reasonably amenable to moats, for instance, typically brands and cost advantages. Whereas an industry like real estate doesn't really lend itself to economic moats. They're typically borrowing funds from capital markets and purchasing land that's available to the broader public in a competitive bidding process, and it's really challenging to carve out a moat around that. To say nothing of the fact that it's very, very, very capital intensive. Um, so again, not a bad place to start. If you're a utilities company and you're pitching for a wide economic moat, you can see in the far right of that chart that that's perhaps a little bit aggressive, at least based on the companies we cover, but not impossible. Obviously, there's at least one. Best practices and recommendations. This is probably the most important slide to fixate on here, so we'll spend the most time here. One, make sure that your qualitative and quantitative arguments align or can be explained convincingly. So if you're pitching for a narrow or wide moat and your returns on invested capital are below your weighted average cost of capital, it's going to be a much harder pitch. Not to say that it's impossible. If you've got a company that's saddled with goodwill and intangible assets and you believe that they're not going to be acquisitive moving forward, and the returns on incremental capital, the returns on new invested capital are going to be quite high. It's a pitch that you could possibly make, but you do have to make sure that, particularly when those arguments don't align, you're able to explain to the committee why not and the way that you believe they should look at this business and its competitive positioning moving forward. Second, make sure to outline ROIC trends over time and comparisons relative to competitors. Obviously, we strive for internal consistency globally. That's a point that we're going to harp on this slide. Um, so comparisons are important. In terms of ROIC trends, let's say the company's ROICs are declining between 2017 and 2020. Probably good to know why that is. And then, relatedly, is that third point, being able to explain structural changes is really important. So if you've got ROICs that hover around that 10 or 11% range, and all of a sudden you're forecasting ROIC expansion to 15 or 16%, the committee is naturally going to be skeptical, and you really got to be able to explain what it is about the business that has changed, that has driven structurally higher profitability. Maybe it's a shift in the business mix. Maybe it's an attractive acquisition that they made that changes end markets. Maybe it's just an industry that's growing top heavier in a winner take all or winner take most industry that boasts network effects. Maybe on the other side of the ledger, you operate in an industry that's really exposed to secular declines like linear TV, and you're actually forecasting structurally lower returns on capital. Whatever it is, just make sure that you're able to explain things that stand out, like structural changes in margin, structural changes in reinvestment needs, and structural changes in returns on invested capital that would follow. Fourth, make sure to consider each moat source independently and craft a compelling narrative. So, moat sources should stand alone. If I'm pitching a company that has a brand intangible asset and a cost advantage, the cost advantage should hold up absent the brand intangible asset and vice versa. This is something that frequently gets violated with what analysts like to call secondary moat sources or contingent moat sources, and that's technically not part of our methodology. So again, should be able to stand alone, even if one is more important than the other. Fifth, reach out to relevant global analysts before submitting a pitch. Back to internal consistency here, but they can also provide really useful feedback. So these are the people globally that understand your business better than anybody else, arguably maybe better than your director. And so that can be really helpful as you craft your pitch, and they might provide things that you should think about or poke a couple holes in your argument. So make sure that you do that well in advance of your pitch deadline, and do respect their time. Sometimes they need as much as a week or two to have a chance to look at a pitch. So keep that in mind. Next, make sure to have your model open during the meeting. This is a really easy one, low-hanging fruit. You're going to know a lot of the numbers offhand, and you're going to be able to anticipate a number of the questions that you'll get. But voters like to get into the weeds and probe model assumptions sometimes. And I can guarantee that you're not going to have every number memorized. So this can make everybody's life, including your own, easier to have that fallback. Next, it can be really helpful to batch relevant companies where possible. Not relevant, obviously, for our Moat pitch training. But if you're covering the three healthcare distributors, it can be really useful to just take them all at once, and you're able to sort of copy paste the write up. It's easier on the voters. It's easier to be consistent within the Moat committee, and then it's probably easier for you as well. Finally, and this is really important, consider whether your data directly support your argument and observe the principle of smart brevity. So I see a lot, particularly with younger analysts, a propensity to tell us everything that you know. And that's actually, in many cases, going to be dilutive to your Moat argument. So if you've got three really good points and then two kind of okay or not very good points that might support your Moat argument, and I read through three really strong points and then two pretty weak ones, it actually weakens the body of work and makes me generally more skeptical about the company in general, whether intentional or not. Um, I would say that your best bet is to just outline your strongest arguments that are directly linked to the Moat sources that you're pitching, and then stop there. I think that's better for everybody. And if you need to talk about some of the other points, you can bring that up in the Q&A, and you can bring that up with investors. And it's good that you did that research, but we don't necessarily need to see everything that you know. A big part of the job is figuring out what's most important about your industry and distilling those conclusions and presenting them to investors. We'll talk a little bit more about that later. In terms of things to avoid, I would recommend that you outline alternative views. It's technically required. So if you're pitching no moat for your company, make sure that you highlight the case in which it could be considered a narrow moat company and what you might need to see to push you in that camp. If you're pitching a narrow moat company, you do have to outline both what keeps us from pushing it wide and what the wide moat argument might be, and then what the no moat argument might be for those companies as well, and the potential your take on the validity of those arguments. This can help focus the committee on the relevant issues at hand for the company that we're looking at, and it can help keep the conversation quite a bit more focused. Second, avoid shotgun explanations. Again, focus on sources that are relevant and can be clearly explained. So if you're pitching an apparel company, a manufacturer like Nike, you know, and most investors know that the relevant mode sources are intangible assets and cost advantage. You don't need to tell us why it doesn't have a network effect or efficient scale. That should be self-evident. If investors ask about that, you can always explain it, but you don't need to spend valuable real estate on that. Third, be careful about internally inconsistent ratings. So that's globally consistent and that's consistent on an industry level. If I'm, for instance, pitching McDonald's as a no moat company and Starbucks is wide and Yum Brands is narrow, I should be able to tell the panelists why, and I should be able to create a compelling and repeatable thesis across that industry where you can say, all right, well, companies that have A, B, and C characteristics fit the no moat bucket for this reason, A, D, E, and F fit in narrow for this other reason, G, H, and I fit in wide for this third reason. If I can't do that, I probably should take another hard look at the company that I'm looking at. Our ratings need to be internally consistent. We publish our research broadly and to all of our clients on the distribution channels. If they read a McDonald's pitch and they read a Yum China pitch and they see that there are a lot of incongruities with the framework that we're applying, that's not a good look for Morningstar's research quality in aggregate and globally. So we really need to be careful to avoid that. Finally, be cognizant about rambling in your answers. This is back to presenting your strongest and most relevant arguments. This is something that plagues a lot of younger analysts and a lot of associates as you get comfortable with questions and answers. I would say best practice is almost to pause and think about what the committee member is really asking about and why they might be asking about that, and then provide them with just the context that they need to have an answer to that question. And if they have follow up questions, you can answer those. But one of the bigger mistakes that I see in interviews and in client meetings is analysts straying beyond their circle of competence. Anything that you mention in your pitch, in your questions and answers, can be and often is asked about by the committee, by clients, by the interview panel. And if you're not confident in your numbers and your knowledge of the industry, if it's not something that you want to find yourself talking about, then you have to be really careful to steer the conversation toward the stuff that you know and the stuff that you think is important. The longer that you talk, the more likely that this sort of thing happens. And separately, the longer that your answer is, the less likely it is that the panelists are going to take away the right conclusions. So again, we're back to the principle of smart brevity, where if you have two good arguments and two bad arguments, then it really weakens your answer relative to just presenting the most important points. So with that, thanks everybody for your time. I'm excited for this training. I think it's going to be great. And I hope that it prepares you well as you move into your analyst career and as you prepare for analyst interviews and client meetings moving forward. Thanks so much for the time.